What's up, guys? Mike Sharp here again. This is Sharp Investing, and I'm going to do a big StoneCo update here. We're going to talk about quarter three, and I'm going to go over some of the highlights from the Investor Day presentation. So sit tight. This is going to be probably a long one. First off, this is not investing advice. Nothing here is. This is just me posting my moves and my thinking on YouTube so I can track my own portfolio. If it helps you guys, great. If it doesn't, too bad. All right, quarter three. Well, I don't know how much there is to say. The company is absolutely rolling now. The thesis is working. They are up another 317 customers, which is over 10% quarter over quarter. They're taking market share from the competition. Banking and credit are starting to ramp up. This is starting to look really good. And additionally, the margins are, as expected, are expanding really quickly. We're up to 17.3% EBT margin, and that is up from 6.6% year over year and up, 2.2% from last quarter. So the operating leverage and the incremental margins are really starting to click now. So in addition to the company rolling, the stock has actually started to move now. So it didn't move for a long time. It's kind of stuck in various ranges, and recently it has broken out. And I think that is partially due to the Investor Day guidance on the 2027 goals that they have, and which are conservative, actually. I'll talk about those in the next part. And also the market generally is starting to move. Like for the first 10 months of 2023, there was really, only 7 stocks, the Magnificent Seven, the Apple, Google, I don't know if Google is included, like Nvidia, Meta, all the big, huge tech companies that they were accounting for most of the market gains through 2023. But since the last couple of months, the rest of the market has started to rally, and stuff like StoneCo has really, got some wind behind its sails. Now, I do think this is maybe not permanent. StoneCo, I do believe it's still getting lumped in with sort of the Cathie Wood disruptor garbage that's out there. I mean, she had a lot of stock. Like Cathie Wood's quite good at seeing businesses that are gonna do well in terms of a product perspective, but maybe not financially well. But I think StoneCo still might be lumped in with the ARK investments at this point. So if the market goes down, the Nasdaq comes down, probably StoneCo is going to come down with it. The other thing that's happening is Jerome Powell really put some wind behind the market sails by talking dovish, which I didn't expect. That was at the last conference, and the market has really taken that and run with it. Interest rates are coming down, stocks up. Again, could be temporary. Getting away from that stuff, the actual financials of the company, I'll just go over some high-level stuff here. The revenue is up to 3.14 billion reais, up 180 million quarter over quarter. The incremental margins this quarter was about 50%. They had 92 million in extra service, admin, and selling costs. Now, I think that was a little bit high, the growth rate in those expenses, but listening to the Investor Day presentation and call, I think that the administrative expenses are not going to grow a lot from here. They said they'd probably grow in line with inflation, right? So they're done, I think, adding to their infrastructure, and we should really see incremental margins of more than 50% going forward. Maybe it'll bounce around quarter to quarter, but I'm thinking it's going to be bigger than a 50% margin on growth. So the one thing that did come down a little bit was financial expenses. So actually, admin expenses came down a little bit. Selling was up a little bit, but financial expenses started to come down. This might be a tailwind in 2024 if the central bank keeps cutting their interest rates, but we might be starting to see the benefits there. So that, keep an eye on that one. Now, keep in mind, those do naturally grow as the business grows, but there might be a counter trend move by the interest rates that more than compensates for that. Okay, so three big paths to big profit growth in 2024 I see is, like I said, the operating leverage could be huge here. If, as an example, if they grow by 15% this year, excluding credit, I'm not going to include credit in this, that would add 1.8 billion in revenue for the year, and at 50% margins, that would add another 900 million in EBT. But as they talk about a lot, they talked about it a lot this quarter, that the cost management's a priority for them. So I'm like, maybe let's say 75%. If we got a 75% margin on that growth, that could add 1,350 million to EBT to the bottom line, which means that in 2020, let's say 2024, we could see earnings of something like 2.7 to 3 billion in earnings. Now that's way below their targets that they've set on their Investor Day presentation, which I think they've completely lowballed, but I could see it quite big. And if you get into that range, you're sort of in the 500 million to 550 million USD in EBT, which means that they're trading about sort of 10 times that right now, which is quite cheap for a fast-growing business. And just as a note, I think that their 2023 earnings will come in around 1,800 million, 1.8 billion reais, and which would mean that they're trading at about just under 14 times earnings right now as of January 6th. The other ones, let's say, so I guess getting onto the big news in this quarter was actually the credit side. So the credit product that they've been testing for quite a while now, they have actually started to ramp it up. They're done testing and they're actually growing it. And the credit, the book has grown by sixfold in this quarter. Now, these are coming from a pretty low base in quarter two, but being at the end of that process, they're saying the loan losses have been quite good. The results have been quite good. The head of credit, who came from another big bank, says that he's seeing loan losses less than they've seen at his previous job. So that sounds like it's going really well, and I think this is potentially a big catalyst for the stock next year. Now, keep in mind those estimates that I've given in terms of revenue and profitability, those are excluding the credit product. I don't really know how to model it yet. I have to wait to see how it starts coming in. We could use the results from previous when they did have the credit product active, but I think that they're attacking it quite differently this time. So I don't think that's going to help a lot. So credit, again, still a bonus on top of that 2.7 billion in earnings, pre-tax earnings that could potentially happen next year. Other big things here, the banking clients are up to almost 2 million, which is more than 60% of their customers are now banking clients. They're bundling their products for new clients, and the uptake on that seems to be quite good. So having clients that have multi-product accounts allows them to access things like credit probably more easily, because they're doing more things with Stone and probably more willing to take on new products that they offer. So bottom line here is that the company is just doing really well, and I think that I'm quite happy to just continue to hold this. Now, there is a fairly big risk that I haven't really talked about yet, and I will talk about it near the end. I'll timestamp it as well, but there's a risk that I'm seeing that one of the analysts asked about in the Investor Day. Now, speaking of Investor Day, let's move on to that analysis. Now, I'll just talk about some of the high-level things that I thought were interesting, but if you haven't looked at it or haven't listened to it, the call is quite long. I think it's over 4 hours. But if you don't have that kind of time, you can flip through the presentation that they've made, and it gives you a pretty good idea of the things that they've talked about. So my main takeaways from this investor day are that they're still reinforcing that they are extremely customer focused. Now, this is one of the things I love about the business. If your customers are happy with you, that puts a big moat around them, right? I think they're number one in customer satisfaction, and they're still absolutely committed to that, even with the CEO change. So that's really important. Because that is your part of your moat. The other part is obviously the one-stop shop where all the products are interconnected and intertwined and easy to use together. So they're trying to create a service moat or an ecosystem moat. Now, one of the other takeaways is that, so Pedro Zinner is the new CEO. And me reading between the lines here, what I think has happened to this business is Tiago, the previous CEO, was the innovator and the builder and the guy who loved to create new things and try new things. And he's created some really good parts of this business. Plus, they have a whole bunch of little projects that are going on. And it looks to me like they brought Pedro Zinner in now to say, okay, we're now shifting from innovation mode to milk the cow mode, right? So Pedro Zinner is really focused on just using the stuff that's working, using the bits of the business that are working, financial services, software, and credit and banking, and really getting those working really well, managing the cost side so that they can increase their margins and really start growing the cash flows. So, yeah, I think that, so Tiago built the cow and now Pedro's come in to milk the cow. Okay, so the main priorities of the company are as defined here. So it's win the MSMB segment, right? So that is, continue to do what they're doing, take market share, give customers the products that they want, so that there's no reason, and the service that they want, so that there's no reason for them to choose a competitor, and that is going to cement them in the industry and take market share from all the other competitors. The second one is increase engagement. So that means, basically it means getting more products, getting clients more invested in the ecosystem, and adding new products to customers that don't already use things like banking or credit or software. So they see, one of the metrics they said is there's a 2.3 times the revenue on the heavy users of their product versus the light users or the one product users. So that shows that even outside of growing the customer base, they still have a chance to significantly increase the revenue per customer as they go along here. And then the third thing is basically increasing operational leverage, which means cutting costs, leveraging their platforms, and basically this is the milking the cow mode. So those are the main focuses that Pedro's talking about. Now, if we go into engagement, they're really concerned with their customer experience, like I said, and that's a great piece to the business. And they have a 3-point plan to differentiate themselves on the customer side. 1 is sales, 2 is logistics, and 3 is customer service. So now they have these Stone hubs that are all over the country with these, they act as sales hubs and service hubs. And so they're able to connect with potential clients or existing clients quite easily because they're distributed all the way across the country. And on the logistics side, like let's say you become a customer of Stone, they can get a POS system to you within 24 hours and get you set up on that system, so you're ready to go and take revenue and earn revenue from your customers. And the last one, the customer service side, they have famously they have this sort of 5 seconds, and there's a book called 5 Seconds to StoneCo, which is interesting if you're an investor in the company. But basically, they answer the phone in five seconds if you call them for a service, and then they try and resolve your problem really quickly. And if they can't do it over the phone or over the app, then they send out these guys called Green Angels, or these people called Green Angels, and they come and visit you at the store and try and solve your problem. So really investing in the customer experience there. Okay, looking at the sort of banking credit side, they actually just got their license, their banking license on January 5th. So that can really help them on the credit side. And as they get deposits, as they grow their banking side, that actually helps them reduce the cost of the capital in the balance sheet so that they can lend it out, at a lower cost to their credit customers. So credit, they're saying the opportunity is 56 billion. So this is a massive opportunity for them. This is the big fish, right? The point of sale devices, that's sort of a limited market, right? Because, in US or Canada, you can see that market is basically saturated already, right? And once everyone has a system, then there's no real growth left except the annual fees that you can increase. Now they can obviously sell other products, but I think the big growth path here is to get this credit offering correct, because the market there is massive. And so they did answer one of the questions. So what are they doing differently on credit this time? Why will it not blow up this time? And like it did a few years ago. And so they're saying a few things. One, they've got registered collateral with the repository system, the repository central system there. And so if the person defaults, they can collect the collateral, right? Which they didn't have that set up before, right? So they actually have the ability to grab the money back if they need to. And plus, they have the credit card revenue as well. They can pull it back from there as well. So there's some protection there. They also have personal guarantees that they've added. Surprisingly, they didn't have that before. Like unsecured product with no guarantees. That's a little surprising. They didn't have that the first time around. And then they have monthly repayments amounts that are necessary. Now, I'm not sure that they mentioned this as one of their things that they've done differently. So I guess they didn't have that last time. Again, surprising. That could be wrong though. So you might have to correct me if you know the answer to that one. But they also have this ability to monitor the credit behavior on an ongoing basis, like in real time, because they have all this other data. So they can change their lending criteria as they go along, which I don't think that they were doing previously either. So there's a few things that are quite different here. They also have the head of credit that was from Santander, the big bank. So they have more banking DNA built into the company at this point. Okay, so then if we look at the forecasts, for the credit, they're saying that they're expecting a portfolio of around 600 million in 2024. That's a little bit light. I was expecting a bigger number, but these guys are the lowball kings. They really, the targets that they set up for themselves are actual, like these bottom level minimums, right? And usually they beat most of the numbers they say. So I wouldn't be surprised to see this number quite a bit higher. Now that might be wrong. They might still take their time to just make sure that they've got the loan loss provisions correct, and that they are scoring the customers correctly. So they might still go a little bit slow and then ramp up. So by 2027 though, they're expecting a portfolio of 5.5 billion, which is pretty healthy, with an expected loss rate of about 10% on that portfolio. Now, I don't actually know what they're charging on these working capital loans, but I would expect it's pretty high given the interest rates in Brazil. I think it could be as high as 30 or 40%. So do the math, 30 minus 10, they could make a 20% margin on these credit products. So could be a huge cash flow generator here. And as we saw, like back in what year it was, before they blew up, they were running at 30% net margins, right? So that shows you the profitability of credit in the past, right? They're running at 17% now, which is a good quarter for the actual financial services and software portion of the business. So it would have to have dragged up those percentages even further to get to 30%. So it's quite possible the margins could expand pretty quickly from here. Don't quote me on that though, because this is all just speculation. Okay, so let's talk about net income targets. This is probably the one that the market cares about the most. 1.9 billion in net income in 2024, and then 4.3 billion, these are reais, in 2027. Now, this seemed like, when I first saw that, I was like, what are you talking about? Like, they're actually on track for 1.7 billion as of quarter three. If you annualize quarter three, 2023, they'd be at 1.7. And I was like, what's going on here? Is something going to go wrong next year? And one of the analysts actually asked that question, and they basically answered and said, this is a really conservative number, right? They hit it right on the head. They said, you know what, we're on track to do 1.9 already, just with the TPV growth without credit. So keep in mind, these are conservative numbers. So that's from the horse's mouth. So I think that like I said previously, I just can see about 3 billion this year, like on the upside. Well, that would be EBT, so they have to take tax off it. So let's say maybe 2.5 billion. But even 2027, 4.3 billion, that's pretty conservative as well. They said that about all the numbers. So, like, that's a pretty good number. And I think this is the number that the market's reacting to. It's going, oh, 4.3 billion, let's use the current exchange rate. That puts them over 800 million in net income in 2027. We need to re-rate this stock higher because it's nowhere near being worth that that income in 3 years, right? So I think part of this is a revaluation, and again, I think that's light. I could see them easily over 5 billion, but who knows? That's 3 years away. There's a lot that could go right and could go wrong in that time. In terms of cost management, they've mentioned this a lot, right? They're really working on the cost side, which is surprising because, I think the costs look like they've been pretty well under control over the last year and a half. They really haven't moved up at all. Well, a little bit, but just minor moves in the cost side. But they're saying we haven't even focused on this yet. That was really surprising. They said, oh, we haven't focused on cost management, so we're going to really focus on that area now. And you're like, oh, okay, it can actually get better. So one of the examples they gave was that the customer service expense per customer is down 44% over last year. So I guess they have worked on that, but they do think that that can improve because their mentality is don't just stick customer service people to solve problems. You figure out what the problems are and then you solve it at the source so that those problems don't come up and you don't have to service the customers as much because the problems aren't arising, which is, it's pretty obvious, right? It's a pretty rational thing to do, but I don't think a lot of companies do that, if I'm honest. So, and then again, back to the admin cost side, they said that should just grow with inflation. So basically, pick an inflation rate, 5%, 10% versus this, massive revenue and revenue growth rate. You'll see there's a gap that opens up there for operating leverage. One analyst asked about international expansion, and Pedro basically said no. He said we're open to the idea if an opportunity really comes up, but he really wants to focus on these the 4 key areas of the business and not get distracted, right? So he's just going to focus on the key bits of the business and get those really, really right and make a lot of money from them, which is kind of what you want to hear. Maybe not though. I kind of think they should still be in growth mode, actually. I think that maybe I disagree. I don't know if this is the right time to really start fully milking the cow. I actually, now that I think about it, I think I would like them to keep expanding, right? Because if a product like this is there's demand for it in countries around Brazil, why would you not take a look at that, right? If you have a model that works really well. So maybe I think they're cutting off their growth avenues a little bit early with this answer. But then again, going to a different country is a totally different ballgame, right? So I'll leave it with them. Pedro's obviously better at this than I am. So risks. Okay, so one of the big risks here is, I have actually been thinking about this for a while. So when a merchant gets paid via credit card, the credit card transaction happens, and then the funds are released 27 days later. So there's this gap where they don't have access to the money that they've earned. And so what StoneCo does is a chunk of their revenue comes from these prepayments, right? So they say, we'll forward you that money and we'll charge you, we'll take some money off the top as a fee, and then we'll collect then the credit card payments come to us instead, right? So, they earn pretty good interest rates on that and pretty good margins on it. And I was actually listening to an interview with the Nubank CEO, and he said that in 2017, the government almost basically announced that they were going to cut that to 2 days, right? Just overnight, they said, we're just cutting this to 2 days. And he said that would really hurt Nubank, maybe destroyed them. And I think that kind of thing would have a huge impact on StoneCo as well. So the real risk here is that, I think most of the world doesn't have these 27-day, these big long periods where the funds are released. And so the risk is that the government makes a change just randomly at some point to try and help these merchants, right? Like, because it's just an extra cost for them to have to pay to get access to their money. So a left-leaning government like Lula's may make that kind of decision at some point. Now, I don't have any reason to believe that they're going to make that decision, but I'm just saying that is one of the sort of tail risks that is out there. Now, we can add on that the risk of just government doing something else stupid or something else that would really hurt them randomly is there as well, because that's, I think that's always a risk in investing, particularly in Latin America. Now, to get back to this prepayment idea, one of the analysts did ask this question. He said, well, what about the risk there? And they basically said, we're on top of this. We have people looking into this all the time, and we don't think that is a risk at all. And even if the government did try to make that decision, basically we'd be in the room talking to them along with all the other banks and everything. And right, so you might maybe there's a bit of a cronyism going on here that's working in StoneCo's favor, but they basically said that that's not actually a risk as their answer. Couple of other risks here. Currency. The currency is probably going to deteriorate over time. That's what these. That's what most countries do against the U.S. dollar, right? Except maybe Switzerland, but or China. But most countries have a depreciation over time versus the U.S. dollar. And I do think that will happen with Brazil as well, just based on their economic policies. It hasn't happened yet because their interest rates are pretty high, but as those interest rates come down, there's probably going to be some currency depreciation versus the US dollar here, which would hurt the US listed shares. It might not make the shares go down, but it might detract from some of the upside, right? So what I'm doing is the exchange rate recently has been around 5 reais per dollar, and so when I'm looking into the future, let's say 2027, I would divide by 6 instead of 5, right? So that's sort of been my strategy, just to be a bit safe. It could depreciate more than that, but that's a pretty hefty depreciation rate. I think it's 26%. No, who knows? It's some very high depreciation rate over 3 years, and I can't do the mental math right now. Another risk here would be that I was listening to another podcast for a different company. Basically, they said a company like StoneCo or PAGS or Melli, Melli is Mercado Libre. They don't have banking DNA, right? These are service-based tech companies, and they aren't a bank, right? So that's going to hurt them. That's why they've had problems in credit in the past, and saying that's a big hurdle to get over. If you listen to the Investor Day call, StoneCo says the opposite. They say they actually have advantages on the banks because they have way more data that they're collecting from these merchants to see their to be able to score them with. Plus, they have their new head of credit who comes from a bank, like I said earlier, and they have a little bit of protection because they're actually holding the credit card transactions for these merchants. So Stone right are the banks right, saying that they shouldn't be in this game? Time will tell, and I think 2024 is going to give us a big indication of whether the credit side of this business has legs or not. Okay, so last thing is my target here. So keep in mind this is pretty loose. This is not like don't hold me to this, but this is where I'm looking at currently. I think that I can see StoneCo at a market cap of about 18 billion in 3 years. And the math I'm using to get there is, let's say we get 5 billion in net income. If I use a 5.5 exchange rate, that puts it at 900 million in net income, US dollars. If we get a fair, I think a fair value for a company like this is about 20 times earnings. That would put them at 18 billion. So that's about 3.5x from here. If they continue to buy back shares, I should have mentioned that before. They've been buying back shares like crazy recently since they announced it just a few months ago. That could be another reason why the stock took off, because people are like, oh, they want to buy the shares at this price? I better buy them first. So I don't know if they're as eager to buy them back at 17 or 18 bucks as they were at 10. But if they do continue to buy back shares, then the upside could be bigger just due to a lower share count. So that's it for this long video on StoneCo. I hope you got something from that. If you have anything that you think you want to add to the conversation, throw it in the comments, and other people can make comments on it. But otherwise, thanks very much for watching, and I will catch you in the next video.